Then you've got your economic risk. Well, let's just go microeconomic to Tulsa, right? We've done our research. We know that, they're adding infrastructure and jobs and incentivizing people to move there. And we know that because the job diversification is strong, welcome to the Cash Flow Chronicles. I'm your host, Jonny Catani, and the founder of Catani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? Happy Friday. Welcome to another episode of Friday Follow-Up here on the Cash Flow Chronicles. I'm your host, Jonny Catani, and another week is down. Holy cow, it is officially June. Happy June, everyone. We are officially halfway through the year. I'm not really sure where the first half of the year went, but if you're like me, it is absolutely flying by, which is just so crazy. And hopefully you guys have awesome summer plans. We're officially rolling right into summer months. I think June 21st-ish is usually the official summer solstice, kicks off June. I know I've got some awesome things planned. Hopefully you guys do as well. Okay, so we've got a topic I want to get to today because it came up recently when I was having a conversation with a friend, and I've noticed it a lot. Well, I shouldn't say a lot, but I've noticed it with a lot of newbie investors, those particularly who have not made an investment yet, specifically a passive real estate investment. So we're going to get to that because I want to touch on it and how to overcome it. Second thing, if you guys have not listened to Wednesday's episode, I break down the final agreement for the debt ceiling. I mean, if you want to call it an agreement, but I break down what they're going to do and why they agreed to raise the debt ceiling and avoid default and what it means for both sides. So go listen to that. That's Wednesday's episode. And of course, you guys, please go to the cashflowchronicles.com. If you're a new investor specifically, this episode is for you. Also, go to the cashflowchronicles.com, same name as the podcast, and sign up for the new 5-part passive investor video series, which will be out soon. Also, I'm officially, so the Facebook group actually got created a while ago. Same name, the Cashflow Chronicles. Go to the Facebook group, start joining the Facebook group. I'm going to start pushing that hard because I'm going to start really focusing hard on LinkedIn and Facebook. And the Facebook group is going to be where I focus all of my attention. So the Cashflow Chronicles, that's the name of the group. Go there on Facebook and join, and lots of awesome things to come. So let's talk about this. Okay. So really what I want to discuss is I want to discuss a little thing called analysis paralysis. You guys may have heard of this before. And basically all it means is that when you overanalyze something, you almost do the opposite of your intention, right? So obviously you guys know I have talked ad nauseum on here about how important it is to understand what and how, but also your why, right? Like I've preached to death about your why, but part of that comes with your education and understanding what you want to do, how you're going to do it, right? Setting your goals, learning your risk tolerance and your investment thesis, right? I've talked about all of those things, but the one thing I left out is analysis paralysis. And essentially all this is when you overanalyze and you overeducate yourself, you almost go backward in the sense that you studied so many things and learned so much all at once that you've actually overwhelmed yourself and have now given yourself almost too many options, right? So for instance, let's say I studied Phoenix, Salt Lake City, Tulsa, Jacksonville, and Charlotte, North Carolina, right? 5 markets. And then let's say I studied A and B class multifamily in all of those markets, and I found 3 operators in each market. That's 15 operators. you've now done due diligence, educated. So you've now learned the ins and outs of 5 markets, which not bad to have an array of markets for sure. So you're okay there. But now you've got 3 operators in each market. So it's 15 operators that you've now done due diligence on, right? You've listened to, let's say 50 different podcast episodes, read 3 different books, and you've studied 2 different asset classes in those different markets, right? Now, this is a lot, and I'm being a little bit dramatic and exaggerating for a reason, because I want to make a point, because I want you guys to know that just like when I talked about diversification, I did an episode on diversification last week and how you can over diversify, you can overanalyze, right? And let's say in those markets, you started, on top of all of that, you started underwriting deals, right? Just deals that you found through your inbox, lists that you're on, webinars, whatever it may be. When you do that and you see so many numbers and so much is going through your head, that overanalyzing, essentially what you do is you overwhelm yourself. And you're now so overwhelmed because there's so much, you have so much information and so much knowledge that it can be very challenging to actually determine where you want to invest, with who, and into what, right? And so this is why I talk so much, and this is why I left this out, and why it's so important to find your why and to come up with your investment thesis and your risk tolerance and stick to that, right? And ultimately, you guys, I can't tell you how many people I've come across who, and the reason this came up is because I talked to a good friend who's looking into syndications, and, he's doing his own research, and I respect that, right? I don't think that everybody, even my own friends, should need to necessarily reach out to me because, they want to formulate their own opinions, and I'm all for that. But in conversation with him, what it sounds like is he's reading so much and looking at so many different things that he's basically overwhelmed himself and is having a harder time making an investment decision. And ultimately what it comes down to, you guys, is no matter how much education you give yourself, how much data you analyze, there's always going to be a risk. You're never going to bring your risk down to 0, right? And if you want to get wealthy, then your goal shouldn't be to bring your risk down to 0. Now, certainly your goal should be asymmetrical returns, aka risk adjusted return, meaning that when you take into account all the risk, right? So, debt risk, time risk, market risk, economic risk, financial risk, right? All of the risks that go into, let's just say, a multifamily investment, right? And there's others, but, we'll just use those 5. You can analyze those risks in a certain deal, right? Let's just say one specific deal, right? Let's just say I've been talking about Tulsa lately, and I like Tulsa, and you guys will hopefully soon learn why I like Tulsa. Hint, hint. But essentially, so you look at all these things, and right. So you find an operator, you're looking at a deal specifically. Okay. So they have fixed rate, right? So they've got a Fannie, Freddie, they've got fixed rate debt. Okay. That's great. Boom. There's your risk right there, because now they have 10 years. Right. And this is all very basic. Okay. I don't want to get deep into the weeds here, because I'm going to keep this very high level. I understand there are other risks that can come with, for those seasoned investors are probably like, well, what if you're trying to refinance or you want to sell early, right? Blah, 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 right? I know there's other things, but just for the sake of it, to make it easy, right? So you've mitigated your debt and interest rate risk to a certain degree, because you know that this rate is fixed for 10 years. So you know what your mortgage payment is going to be for the next 10 years, right? Then you've got your economic risk. Well, let's just go microeconomic to Tulsa, right? we've done our research. We know that, they're adding infrastructure and jobs and incentivizing people to move there. And we know that because the job diversification is strong and they're not focused on one specific sector, that we've been able to mitigate, and we don't have to worry about, all of a sudden tech leaving, right? Because it's just not a heavy tech market anyway, right? So we've got that out of the way. We've got our finance risk. Okay, how much money are they raising? How much is there for CapEx, right? Right, to cover deferred maintenance and upgrades, right, to renovate apartments. Okay, so we've got that out of the way, right? We know they've done this before. We know they got a rinse and repeat method. They're bringing in the same group that they've used before, and it's going to be just like a deal they did 2 years ago. Boom, right? So that's out of the way. Then what was the other thing I said? Then you've got, okay, so time risk. Okay, so now they're putting it over 3 to 5 years, which you can see from their underwriting where they're going to slowly bring rents up to market, right? They were conservative in their underwriting and therefore are not going to, bring rents all the way up. They're not shooting to bring rents to market year one, right? Not to say that can't happen, because certainly that can happen, but typically you want to see that happen over a 2 to 3 year period, because that's what will happen on a more regular basis, right? That's a lot more common. And the last couple of years were a bit of an anomaly with being able to just walk in and raise rents. Again, not to say it can't happen still. I do see it happen, but ultimately, there you go, right? Boom. So we just covered 5 of the top risks and how they were dealt with from this one deal. Okay. You guys, if all of those things are there, you like the operator, then, there's no reason that you shouldn't be seriously considering investing. Now, I want to put a disclaimer here, and I need to really put this at the beginning of every episode and just record it. But disclaimer, you guys, I'm not a financial advisor, CPA, or attorney. You need to consult your advisors and CPAs and attorneys before you make any investment decisions, right? But if you've gotten to this point, this would be a good time to go to those advisors and say, hey, look, I've done all of my research. I've mitigated. I'm really considering investing in this deal. What do you think? And, their job is going to be to poke holes in it. But assuming they poke the same holes you did and you filled all those holes, again, right? If you want to truly build wealth, you're going to have to realize that, you can adjust for risk to a certain degree, but you're never going to bring it to zero. And ultimately, it's going to require you to eventually pull the trigger. So that's really it, you guys. There's not a lot to talk about there because I don't want to beat it to death and overwhelm you even more. I just want to touch on it because it's something that I see with a lot of new investors. And, I've had conversations. I understand people don't have the same risk tolerance as me. I'm a little bit more gung-ho than others. And, it's got me in trouble. I've talked about the deal I did last year that fell through and I lost the earnest money. But ultimately, what that's led to is me just learning a lesson as opposed to sitting on the sidelines so long that all of a sudden so much time passes that you've now actually hurt yourself because you're taking too long and analyzing too long. So that's really it. That's all I wanted to get to today, to really touch on, to hopefully help you newbies who are overanalyzing really hone in. And again, that's why understanding your risk tolerance and developing an investment thesis are the most important things, because if the deal that you're analyzing fits into that criteria and you're able to check all the boxes, then there's no reason that you shouldn't be, seriously considering investing, right? So there you guys have it. That's really it. That's all I want to touch on today. Short and sweet, but again, very, very important. So one thing I want to leave you guys on that is up-to-date news is the Fed has indicated that they will most likely be pausing their rate hike for June, which the meeting is in 2 weeks from Wednesday of this week. So not this Wednesday, but the next. And they will most likely be pausing, which I said they should do, and have made it clear that just because they're pausing doesn't mean they won't hike it up later. But ultimately, you guys, this is exactly what I said. I said they should pause it so that they can let more data catch up. And what do they say? They're going to pause it in this month's meeting in order to assess more data, AKA let real estate data catch up, which is about a 4 to 6 month lag. So everything's right on track, you guys. Things are looking good. We're not going to go into default. And, you know, we could have a little bit more clear indication of what the Fed's goal is here in a couple of weeks. And as always, you guys know I will keep you updated. So thank you guys again so much for listening. I appreciate it as always. You can follow me on Instagram at Jonny Cattani, well, all social media at Jonny Cattani. I appreciate you guys. Have a great weekend. I hope you all have big plans. Summer is officially upon us, and we are very excited. I will talk to you guys on Wednesday. See ya. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to CattaniCapitalGroup.com to learn more.